The Federal Reserve convened for its 42nd annual economic symposium in Jackson Hole, Wyoming, put on every year by the Kansas City Federal Reserve. This year, the theme, Reassessing the Effectiveness and Transmission of Monetary Policy, delved into the impact of monetary policy on economies following the pandemic and the subsequent surge in inflation. But the bigger question on investors' minds was when the Fed could cut rates for the first time in 4 years.
Our top story this morning, stock futures rising ahead of Fed Chair Jerome Powell's key Jackson Hole address. Now, the annual meeting, it comes at a critical time as the Fed navigates balancing its inflation fight with some evidence of cooling in the labor market. Here with more, live on the ground from Jackson Hole, Wyoming, we've got our Fed correspondent, Jennifer Schonberger. Jennifer, this is what we've been waiting for.
It's what we've been waiting for, Brad. All eyes on Fed Chair Jay Powell in about an hour's time for any new clues on the path forward for monetary policy as he gives his annual speech here in Jackson Hole. The last time we heard from the Fed Chair on July 31st during his press conference following the policy meeting, he said the Fed was getting closer to cutting rates, setting the stage for the first rate cut in this cycle for September.
We think that the time is approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
The latest inflation report, the Consumer Price Index for the month of July, underscored the downward trend in inflation that resumed in the second quarter after what seemed to be a head fake in the first quarter that inflation was stalling. The Fed now has 4 straight months or more than a quarter's worth of inflation data trending in the right direction. At the same time, we've seen softening in the job market, and Powell said in July he does not want to see a material cooling in the job market. Powell and company have made clear that they are focused on both sides of the dual mandate, inflation and employment now, not mainly inflation. And a string of regional Fed Bank presidents have made clear in recent days they are paying closer attention to the job market and they are open to a rate cut in September. Now, traditionally, Fed chairs have used the platform here at Jackson Hole to deliver an important policy message. Powell could use the platform today to open the door further and signal more clues for a rate cut in September, or he could take a step back and delve into a deeper research topic that may be germane to the current environment. Now, of all the Fed chairs over the past 24 years, dating all the way back to the year 2000, Powell has moved the market the most with his speeches here in Jackson Hole, pushing the S&P down 2.6% in 2019 and 3.4% back in August of 2022, the most of any Fed chair with that famous 8-minute short speech on doing what was needed to bring down inflation. We will hear from Fed Chair Powell at 10 a.m. Eastern right here in Jackson Hole. I will have those Fed headlines for you.
Federal Reserve Chairman Jerome Powell wrapping his remarks at Jackson Hole, nearly cementing a quarter-point September rate cut for the markets. Let's take a listen to what he had to say about the path forward for interest rates.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data.
Still data dependent there, but the stock market trading on optimism. The Nasdaq up 1.8% and the S&P holding on to those gains up about 1.3%. But let's get to the broader market action with our very own Jared Blickery. Hey, Jared.
Thank you, Maddie. This was a risk-on event, even for Bitcoin. We'll see if we have time for that. Let's dial up the Wi-Fi Interactive and chart the day's price action. This is the S&P 500, and here is 10 a.m. when we got that big jump up. Also, I should mention, we got an unusually strong housing report. I think it was up 10%. It was just an outlier, and so that could factor in too. But I think the main show here is Powell, so let's stick with that. I do want to show you what's happened this week. This is a 5-day look, and you can see here on a candlestick chart, we are just punching above yesterday's highs. And I was making a big deal on the open about this bearish engulfing pattern that we had yesterday. If we close above those highs yesterday, close above yesterday's highs, that is negated. So that would be very bullish for the market. Here's the S&P 500 equal weight index, and this is at a record intraday high. This is the first record intraday high that we've seen since the end of July. We had a record closing high a day or two ago. And then I want to show you the Russell 2000, which is also heading higher. Now, we were just talking about volatility with Steve Sosnick. This is a 2-month look. So here's that big peak that we had before. And I've been pointing out that we are just slowly inflecting. But here's the 5-day look. We are heading off of those highs that we had yesterday, down from those highs. And so that is kind of a risk-on movement. Got to show you what's going on in the bond market. I don't think we're done there. Let me switch to an intraday look. We can see the 10-year T-note yield down 7 basis points. And here's the 5-day price action. So we're not even quite down to the lows of the week, but that would be an important level to watch. Here's the US dollar index that has hit new lows for the week. And by the way, on a year-to-date basis, it is now underwater by 1%. Just going to close here by quickly showing you the sector action. It is all about tech and consumer discretionary. You look at the mega caps, that's where a lot of this strength is right now. Guys?
The Fed pivot, it's here.
About time. They were looking for it 2 years ago, and that disappointed the markets. We finally got it. The only question I have is, was anyone not expecting a Fed pivot? I mean, everybody. This has been priced in for some time. I was checking, the CME Fed Watch while we were doing this. We're still expecting. We were expecting a full cut already. The odds have seemed to have gone up a little bit, maybe 30% chance of a 50 basis point cut, but. It's great. He ratified what the market's thinking, but there's not a lot of big surprises either way in here, and it does tell us that we better be watching the data that comes down the pipe in the next couple of weeks.
So Stephanie, when we talk about the data that's coming down in the pipe the next several weeks, obviously a lot of that is very dependent on that next jobs print and what we are getting. We certainly just got a lot of commentary from Fed Chair Jay Powell talking about the cooling that he is noticing. He used the word unmistakable in his speech, but I'm curious whether or not you think, given the fact that gradual actually wasn't used within his commentary does that make a 50 basis point cut then at the next meeting maybe a bit more probable?
I really don't think so. I think the Fed wants to be measured going forward. I think if there is a 50 basis point cut, it's really a reaction to a poorer jobs number or some other economic data that really concerns the Fed and cause them to move further than currently priced in. I think as far as where we are with the data, I think the expectations are that we are seeing a little uptick in the unemployment rate, but the expectation from here is I think we can see some stabilization, and I think the Fed wants a measured pace going forward and not scare the markets.
Steve, let me go to you on the labor market here, because it seems that is, of course, the biggest risk, as you mentioned here. What do you think is the right number for the Federal Reserve right now to get in the next jobs report?
I think they want it no worse than what we saw before. There was some question in the last jobs report about how much of the payroll offset or the unemployment claims are related to temporary measures about Hurricane Beryl in Texas. Right. I think it'll be interesting to see how much of those reverse. Obviously, the BLS revision was a big surprise. You can't just wipe away 800,000 jobs. Mm-hmm. On the other hand, 800,000 jobs in an economy where 150 million people or so are employed is not a huge number. Mm-hmm. So I think though we want. This is the problem. Does the market want a poor economic number so that it gets more rate cuts, or does the market want a good economic number so that people can afford to buy stuff and the economy hums along? Mm-hmm. When in doubt, I prefer to vote for a stronger economy. It's not so clear that everybody thinks that. I think that people really would rather rate cuts, which is a little tricky to be in, because sometimes you got to be careful what you wish for.
Steve, I want to play a quick bite that we got from Powell. He was talking about some of the risks that do remain, the fact that the Fed still has flexibility at this point, given the high rate that we do see. Let's listen to that, and then I want to get your reaction on the other side.
There is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
So, Steve, how should investors be thinking about that? I guess just the fact that maybe this gives them a little bit more confidence in terms of the fact that maybe we won't see the dramatic moves or that type of volatility that maybe had been a little bit in terms of those that were, I guess, pointing to maybe sort of that skittishness that we have seen in the market.
I think it gives us some more confidence in the idea that they may not be slow as they might not be as slow on the uptake if there's a recession looming that I think people feared. We all knew that they have plenty of room to cut rates. We have 5.25% Fed funds rates. There's plenty of room in there. But I think the concern was that they would be a little slow to utilize that measure. He's pretty much saying here that we'll break glass if necessary. But it's what he's not saying here is that we're going to do it prematurely. He hasn't really still given us a clue to the pace. So to me, are we looking at one, as Stephanie said, a rate cut every other meeting kind of thing, or are we looking at something more aggressive? And I think again, the aggressive is if we need it, and that could be a little bit tricky.
So Stephanie, we did get that dovish turn, obviously, but how do you manage your investments when you've got this backdrop that is currently slowing but could turn into slow on the heels of any data point?
Yeah, it's a tricky market, right? I mean, more recently we saw, small caps take off and then a complete reversal. You're wondering if the economy is going to slow so much that it causes a recession. So I think right now we're still in the camp that the Fed can orchestrate this soft landing. We haven't seen concerning economic data. So for our clients, we're telling them to stick with their plan. If they have money on the sidelines, we expect there is going to be some volatility coming up. So that's a good time to deploy that capital. I'd also say, stay measured and don't try to be whipsawed by these moves. I think there is going to be a catch-up trade. We've seen some of the laggards, the sectors that haven't been participating, not only start to participate as far as their stock prices, but you're also seeing the EPS growth there for this year and next year. So that's encouraging as well. So I would say stick to your plan. Look for some of these laggards that have strong balance sheets, that are growing their earnings, and still have some reasonable valuations.
Steve, we still don't have much clarity, though, surrounding the destination for rates, right? How much is that going to add to the volatility that we could see?
Well, I think that's going to add a lot to it because we remain data dependent. So, I mean, think about it this way: we've got Nvidia earnings, which are not a Fed event, but that's a volatility potential. That's got a lot of potential for volatility next week. Friday the 6th, first Friday in September, we've got jobs numbers, and based on Powell's comments, you got to be crazy not to be paying a lot of attention to that. Mm-hmm. Then we also along the way we're going to have PCE, CPI, and PPI. All before the Fed meeting, which is about 26 days away, I think. This is the part to keep in mind. VIX, we talk about it as a fear gauge. It's not really. It's really the market's best estimate of volatility over the coming 30 days. By the way, we've had
15?
That's the thing. But we've had sequential 1% moves, right? I mean, today is volatility too. It's what I call socially acceptable volatility, but it's still volatility. Mm-hmm. And so I think the idea that volatility is behind us is wrong. I think it actually does, as Stephanie, I agree with her on this one, that we're going to, there's a lot of things that can bring volatility over the coming 30 days, mm-hmm. Over the coming couple of months. And so I think it's wrong to be complacent. You have to be very nimble and very wary of it. And that's why I think the most important dip to buy is probably VIX.
Loretta, thanks so much for joining me here in
thanks
Jackson
for having
Hole.
me.
It's great to see you.
Great to see you
It's so
too.
strange to call you former Cleveland Fed president.
I know.
So we heard from Jay Powell this morning, and he says the time has come to adjust policy. How do you take that? 25 basis point rate cut, a done deal next month?
Well, I think he was pretty clear. And in fact, he was actually pretty clear in the press conference after the July meeting that this is where policy is heading. And frankly, the case is pretty strong for beginning that process of bringing rates down. Now, this is not, easing policy to be, very accommodative. It's really reducing the degree of restrictiveness. And the case is basically because inflation has come down, right? We're in the 2.5% range now. and the labor market is moderating. That moderation in the labor market is something that we wanted to see because it would get supply and demand into better balance, and that's happening. So, the Fed has to be forward-looking with its policy because policy actions today affect the economy 6, 8, 9 months in the future. So it's really, where's the economy headed, and is this the time now to start that process of adjusting policy? So we're in that phase now, and I think he made it pretty clear that it's pretty clear that's the trajectory. Of course, he was mute on sort of the size of the first cut and 25 versus 50, which I know the financial markets are very, focused on. But in some sense, that's not the right question for this period. It's really about now we're starting a new phase, and the policy is going to be brought back down. The pace and the size of the cuts are really going to depend on how the economy actually evolves going forward.
So in terms of the path forward for policy, he did say that the outlook is going to depend on the incoming data, the balance of risks. You just retired from the Fed in June. I mean, you were voting in the middle of June on FOMC decisions. How do you see the path as we go through the fall and the pace of this?
Yeah. So I think a reasonable sort of baseline would be doing 25. I wouldn't want to start with a 50 because I think that is really a signal that maybe the Fed is behind the curve, and I don't believe the Fed is. I think the Fed has been very careful about really focusing in on the price stability mandate when that was the dominant focus, right? So when we started raising rates, and I can say we because I was on the committee at that point, right? When we started raising rates, it was clear that inflation was way too high, and the labor market was strong at that point. So it was very clear we focus on the price stability part of your mandate. Now, as inflation has come down and labor markets have moderated, it's really looking at both parts of the dual mandate and sort of balancing that. So the real challenge for the Fed going forward is, continue the momentum of getting inflation all the way back down to the goal of 2%, at the same time keeping labor markets healthy. And that's the balance. So as inflation's come down, the risk to that part of the mandate has come down. But as labor markets have moderated, that risk is growing. And how do you keep them in balance? And that's why it makes sense to sort of be methodical about and being deliberate about sort of reducing the degree of restrictiveness, but being attuned to sort of how the economy is evolving and keeping the policy in sync and calibrated well to the economy. When we started raising rates, policy was not calibrated well. And so the Fed had to, go pretty aggressively. But even at that point, the Fed started with a 25, then a 50, then did the string of 75s. Here, the desirable path, I think, would be to do several 25s.
And is
but
that
of course,
quarterly? Is that every meeting, every other meeting, quarterly?
I could see the Fed, in my forecast for the economy, could easily say the next 3 meetings we're bringing 25s. We're going to bring.
So every meeting they could go 25.
I could see that happening. That would be aligned with sort of where things were back in March. Remember when the Fed came out with their SEP, the median path was 3 cuts this year. So, where the economy is, and given the speed which was inflation came down faster than the Fed was expecting. I could see that happening. But again, it's going to really matter on how is the economy evolving and what is the whole, and when we say data dependent or the Fed says data dependent, I think sometimes it's misconstrued as like each data report and you'll see the markets gyrating. But really it's like, what is the data telling you about the outlook?
Right.
Because that's we have to look forward. We have to be really looking where the economy is going, not just where it is today.
How much of the change in policy path now, we're now entering a new regime, as you said, and it's more about not just we're cutting 25 in September, it's about the path of policy. How much of this is to ensure that economic growth continues and that we avoid a recession? Chair Powell seemed to be very fervent about staving off any weakening in the job market. That seems to be the new focus now. They seem to feel that, to your point, inflation is sustainably coming back to their 2% target. It's on the right path. They don't think that the job market is inflationary at this point. What's your sense of the economic outlook, why they are moving now, and the job market?
No, I think it is about really balancing both parts of your mandate, right, and balancing the risks around them. And, the job market is still healthy. right? And the key is, can we get to 2% inflation, keep the job market healthy, and calibrate policy to achieve that? And I think that's what this is about now. And it's sort of making sure that you don't allow policy to get behind or get ahead of itself, and keeping it in tune with where the economy is headed, keeping that dual mandate, right, firmly in focus. And I think that's kind of the challenge going forward.
Do you think we will achieve the soft landing?
Well, I think we have a good shot of it given where things are, but that's what you have to be attuned to, and you have to be viewing other scenarios that are possibilities. There could be shocks coming that we're not anticipating. There are many things that can happen in an economy. And so that's why you always want to make sure that your policy is well calibrated so that, right, you're in a good position. If things evolve, if suppose something happened and inflation started moving back up, policy right now is in a good place. Or suppose that the labor market, the moderation begins to become deeper and more weakening, policy can then adjust, right, and then the Fed could bring down the policy rate faster than anticipated right now. So again, you have to be sort of keep yourself in a position so that you can adjust, right, for the risks that may happen.
On the job market, we've seen the unemployment rate jump by 0.5 percentage point from its low over the past year. We do know that a big part of that is because more people are entering the labor force, trying to find jobs, as opposed to layoffs. Nevertheless, typically when we've seen that jump, the unemployment rate starts to move much higher, faster, and the economy has entered recession. So my question is, can the labor market continue to cool without a recession?
It will probably continue to cool a little bit because, we haven't seen it get totally back into balance. However, right, that's why those risks have gone up on the labor part of the mandate. So that's why the Fed has to be very attuned to what's happening in the labor market. It's still a healthy labor market. And yes, the unemployment rate has gone up, but it's still a low unemployment rate from the point of view of historical. But, we want to keep the labor market healthy. That's a very important part of a healthy economy, is the labor market. And so that's what the challenge is. Let's get back to 2% inflation, but at the same time, keep that labor market healthy. And I think it's achievable, but that's going to be a challenge going forward, is to make sure that they calibrate policy for that outcome.
We are in an election year this year. Donald Trump has said the Fed should not cut rates before the election. Looks like they're going to cut rates in September, as we've just talked about. How do you think a rate cut in September impacts the election, if at all?
Well, I'll tell you, I've been, a Fed person for many, many, many years. And I can tell you, and I've gone to many, many FOMC meetings, that politics does not enter that room, right? The Fed is very focused on its dual mandate goals when it's setting monetary policy, and only on its dual mandate goals. And the best thing the Fed can do is what it does all the time, which is take into account what's happening in the economy, what the data is telling you about the outlook for the economy, what the risks are, and setting policy based on that to achieve over time the dual mandate goals and to maintain it once you've gotten to the dual mandate goals of maximum employment and price stability. So we don't consider, or the Fed doesn't consider, right, the political situation. And in fact, that's important because having an independent monetary policy, everything that you read, all of research, right, has shown that actually yields better economic conditions for the country.
Loretta, thank you so much for your insight. It was excellent. So appreciate it.
Oh, thanks for having me.
Look forward to talking to you again soon.